Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted to be able to speak to Exec Chairman Peter Harris and Finance Director Iwan Phillips of Crestchic, an international load bank and power reliability firm. So welcome, gents.
Good morning, Paul. Nice to be speaking to you again.
Yeah, welcome. Many congrats on today's excellent first half results and very positive outlook for this year and for next. But before we sort of dig into the details, Peter, I don't suppose you could give us a quick summary of the current demand picture for the company's sort of mission critical products and services, given the sort of the economic backdrop.
Yeah, well, they're very interesting economic times, as we know. To be honest, they're sort of working beneficially for us in many ways. The Ukraine situation has really alerted governments to energy security. So we've seen that kick off more exploration to secure oil and gas supplies around the world. Instability of supply of gas leads to concerns about the grid, which in turn makes people worry about backup power, about grid stability, etc., all of which, sadly, is good for us. So though it's an uncertain economic position, the uncertainties work well for our business. In terms of where we see demand now, well, we're almost through the third quarter of the year, so we're well advanced from these half-year results we're announcing, and demand has remained remarkably strong, right through Q3 on both the rental side and on the sales side. So still a very, very positive picture. And we're seeing more visibility into 2023 than we've ever seen at this time of year before.
That's good. And what sort of sectors is it again? The sort of the data centers, sort of extractive industries, and hydrocarbons.
Yeah, I mean, data centers remain very, very strong, and we've expected that. We've seen this as a long-term trend. There's nothing out there to say that trend isn't going to continue. Right around the world, actually, it's very global. We're expanding our footprint into the data center market to piggyback off that. Extractive industries, particularly oil and gas at the moment, rather than mining. Mining's remained strong, but oil and gas has picked up very strongly, particularly on the project rental, which is very good for us. That's been strong. Middle East and Asia are probably the strongest markets, but a lot of activity. Marine, though, the marine area that's growing is also indirectly related to oil and gas because a lot of it's in FPSOs, but that's going well. And then, the other core activities remain strong. I mean, if you're reliant on backup power, now is the time to test it. So
just on that. I mean, if I just be hypothetically, if I put myself as being a sort of like a mission critical sort of hospital in, I don't know, Frankfurt or Dresden or something like that, and I'm sort of at risk potentially of having the gas cut off and going to power rationing or blackouts, etc. I mean, you'd have thought somebody like myself would actually want to sort of test and service the load, the backup power supply before that potential risk. Have you seen any sort of like nascent early testing or servicing of that, or anything sort of like adjacent to it?
To be honest, we haven't seen a huge amount yet. I think there is something going to come through there, and I think that's still to come for us. What we are seeing, and in Germany, we've seen 2 or 3 quite large sales of equipment into the utility sector, very much focused on grid stability. So you're seeing the grid operators and the power companies starting to say, gas supply is tricky, more renewables coming on, and an even greater focus on renewables given the situation on oil and gas. And they're saying, right, we'd better do some more resilience testing and stability work, and we're seeing that come through. But I'm with you. I would logically expect sensible critical infrastructure providers to be testing their backups at the moment.
Well, it may be a marketing thing you might want to do out in Germany, because if I was a prudent German, then that was certainly the kind of thing to do. Yeah.
Well, I'm sure the guys are looking at it.
Yeah. Anyway, Iwan, we've obviously got a brilliant, buoyant demand coming through, and a very strong sort of like Q3 as well. How's that sort of feeding into the numbers? Just really on the extraordinary first half, really, with operating leverage coming through from that top line growth.
Yeah, absolutely, Paul. The business was absolutely flying in the first half. The second quarter, really building up and continuing into the third quarter, and we're seeing it now into deep into the second half. Higher revenue was up 43% with a greater number of large projects. Sales revenue also up 25%, but the impact of the productivity gains that we've seen from our new technical director, with the reorganization of our existing facility, with the increased capacity to come in the second half. High revenue has therefore increased to 58% of total revenue. The overall margin then has increased from 44% to 50% due to this shift in mix towards the higher margin rental revenue.
That's gross margin.
Yes, gross margin, but also the margin from this rental revenue has increased compared to the first half last year from 52% to 60%. So we've got less cross hire, less pass through revenue, and more pure hire revenue compared to the first half of last year. And due to the strong operational gearing, as you mentioned, this 51% increase in margin is translating to a 133% increase in operating profit to a very healthy 4.2 million for the first half. Obviously, translating to cash, the business naturally generates cash, and coupled with the proceeds from the Tasman disposal, we've been able to invest significantly in working capital to ensure that we can fulfill the second half demand in the new factory and in the hire fleet.
And I guess, given you've got that operating leverage, I know you have a very important KPI, the return on capital employed, but I'm guessing you beat last year's 18% by a mile in that first half.
Yes, yeah, it's significantly over the 25% that we've mentioned. Obviously, we'd like to have the full year, and we're investing significantly in the second half. So we will publish our exact figure for the whole year at the end of the year, but very confident now, be significantly up on our target of 20% and what we achieved last year of 18%.
Brilliant. And now, Peter, just in terms of the sort of like bringing on the supply and having the capacity, can you just talk us through sort of like how the new production facility or the extension of the production facility out in Burton-on-Trent, and also the other sort of measures you're doing, improving sort of like utilization rates of the fleet, and procuring products from third parties, as well as the old equipment to refurbish. You can just bring all that together.
I'll try to remember them all and deal with them one by one.
Okay.
So let's start actually with productivity improvements, which Iwan's mentioned already, because I think that kicked in even before the factory expansion. We appointed John Storer as technical director at the beginning of the year. He's had a pretty immediate impact. And if you look at the factory throughput, last year we were talking about an effective cap on sales value of about 14 million out of the factory. Even allowing for price increases, we delivered 8.9 million in the first half of this year. And in rough terms, that's about 15% productivity gain over the first half, which is just a fantastic outcome. And we're very grateful for it. And then the new factory, as you know, was commissioned at the back end of June. We had little bits of production starting in the factory in the first half, but nothing had come out of it. So all the first half performance is down to the productivity improvements in the existing estate. We're fully staffed. I'll come back to that. We're fully staffed in the new factory, so that is now producing. And you know that's a substantial capacity increase. It'll take us a little while to ramp up to it, but we will be seeing more than the 8.9 million through the factory in the second half, as you will have worked out from just doing the pro ratas to get to where our sales forecast is. And in fact, we've just started our new recruitment drive to get a second tranche of new technical operatives into the factory to cope with demand, where we see it being next year and in the future years. So that's really exciting for us. And we originally set out a goal of adding 50% to our capacity through building the extension. Well, we managed to add 15% just through productivity improvements before we even built it. We think that 50% in terms of footprint is still valid, and we know there's more productivity to come. So we've substantially increased our technical capacity, and that should keep us going even through this very buoyant demand and growth we're seeing at the moment. So that's all good news. In terms of fleet utilization, as you can imagine, with the rental demand at the moment, the fleet's pretty heavily utilized. I suspect it's more utilized than it's ever been in the past, which means we're running around like mad, moving equipment here, there, and everywhere. We're investing actually now quite heavily in fleet systems because we realize now sweating the assets is obviously key to return and key to gobbling up every bit of businesses out there and not losing it to competition. So there's a investment program going in on our fleet management software side. In the meantime, we're just doing it as smartly as we can through the old system, and we're definitely getting better and better. And we were always good at it. One feature that's been introduced this year, we have introduced a new minimum hire period for the sort of transactional hire, which automatically increases utilization in terms of less moving around of equipment or less downtime between hires. So I'd say utilization has taken quite a step forward in the right direction as a combination of how we've managed the project rental and changes in our commercial practices on the transaction rental. Still more to go for. So if we're looking at growth, continuing in the rental business, obviously we have to expand the fleet. We're investing in it. That's on several dimensions. We've got quite a heavy build program in H2 from the factory. Otherwise, we'd have even more sales capacity. We're going to use a lot of that extra production capacity to build for the hire fleet. We are still looking at buying and refurbing old equipment. We did that quite successfully in the first half. The market is now very busy, so there's increasingly less equipment out there that's available. But we scour the world on a regular basis, and I'm sure we'll find some pieces to do that. And the other initiative we have, as you know, we're outsourcing some supply, particularly of the smaller units, a lot of which are targeted at data centers. And the US is the first major area we're doing that. And we actually had a problem with the supplier in the US. Not the supplier's problem. They had supply chain issues, and they've worked, long and hard to try and get equipment to us. And we're pleased to be able to say now that around 50% of that order has now been fulfilled in the third quarter, and the balance is trickling through, day by day. But it did delay the full launch of the Texas depot we opened. But, we've taken our first order for the data center market in Texas now and supplied.
Great.
So, in a way, it's a nice problem to have because we delivered this first half result without the Texas depot. And, as you alluded to earlier, that's all to come in H2 in 2023 now.
And Ewan, just in terms of the actual sort of supply chain, what are you seeing in terms of sort of input costs and sort of like, part availability, which goes into the load banks, into the manufacturing?
Yeah, the supply chain for the most common components for a load bank has certainly improved this year, although there are a few key components that are still difficult to source. And obviously, we can only send out a load bank when we've got all the components ready. So it takes some managing, and it does occasionally affect output for some months. But as you Peter alluded to, we're 25% up on output in the first half, so we're managing it pretty well, but it's certainly not gone away. On the cost of these components, so they're increasing all the time, but we are managing that process of fairly passing them on to customers, and we've maintained the margin in the first half, and we will continue to do that.
Good. And Peter, just on the sort of like looking a bit more sort of next year, the strategic opportunity in the US. I mean, we've obviously got first near doors. We've got this hurricane season coming actually on the East Coast. So there's going to be plenty of blackouts going on in Florida, probably, I think, unfortunately, in the next week or so. But in terms of sort of like this, when obviously they use DC and they've got a lot of problems in terms of consistency of power with blackouts, particularly in sort of California. But as I say, we saw it with the big freeze out in Texas only, 2 years ago as well. What sort of timeline and scale are we talking about with the North American market for Crestchic?
Well, it's a huge opportunity for us. I mean, the North American market is not far off 50% of the world market. So just on its own, which is quite staggering, really. And we're single figures market share on both sales and rental. We have had a really good year so far on the sales side. It's gone very, very well. And no signs of that slowing down, which is good. On the rental side, obviously, we believe the rental is an opportunity for us, which is why I've invested in the Texas depot. We've spoken already about the fact that that really didn't happen in H1, but it's starting to happen now in H2. We're pretty confident about it, but we'll know a lot more by the time we come to announcing full year results, Q1 next year, as we'll have had 6 months of reasonable operation by then. But we do see that as a significant opportunity. We also think our traditional markets into infrastructure, into manufacturing, into marine, still have lots of headroom. We're putting additional sales resource into our East Coast depot, the established depot that we have in Pennsylvania. So that's all good. The other constraint that our US hire operation has had to operate under this year is the constraint of our success everywhere else in the world, because we have pirated some of their equipment to fulfill some of the project rental. But that doesn't alter the long-term picture. And the long-term picture there is positive, and it's going to be a big focus for us over the next 5 years or so.
And would the business consider making a sort of like an acquisition there to get a footprint, to extreme? You've obviously built the footprint, but to extend it, accelerate that growth, and extracting that opportunity.
It's always a possibility, either on the manufacturing side or on the rental side. There are no immediately obvious available targets, but we do watch that market very, very carefully, and we're in touch with a number of players out there, and we'll look to see if we can develop different relationships with them over time, not necessarily through acquisition targeting, though that we never rule that out. But I think our fundamental focus is organic growth. We have a lot of opportunities. And I don't want to get distracted onto adventures when we've got really tangible opportunities ahead of us. But if the right acquisition opportunity comes along that's bang in our strategic framework, is affordable, and promises reasonably immediate returns and long-term growth, obviously we'll consider that. And I think the strength of our financial performance gives us the firepower to do it if that opportunity presents itself.
Yeah, well, you're certainly building up a lot of cash at the moment, and Ewan, just on that, sort of like in that context, can you just talk through the sort of the introduction of the interim dividend and also the stock buybacks?
Sure. On the dividend, obviously, we're very pleased to announce today a 1.33 pence dividend for interim dividend, which is obviously higher than the full dividend for last year. It's obviously a very positive sign about our confidence in the business. We've obviously stated that we're looking to progress the dividend over time, so we want to balance the investment in the business and rewarding shareholders. And this is another step on the path to sort of dividend cover that's typical of other AIM-listed businesses over the sort of medium term. On the share buyback, we completed the initial objective of buying back shares for the LTIP that we introduced last year. Obviously, with the cash that we are due to generate, even after the heavy investment, we will have decisions to make next year what to do with the cash, and a share buyback will be contemplated to see if it's appropriate at that time.
Well, I mean, you've certainly done a very astute purchase with the share buyback, because I think the shares are worth a lot more than when you bought them. So well done there.
Yeah, certainly we front-ended that.
Great decision. In terms of the just the bits and pieces on the Tasman, Peter, you look as though it's now it's signed. It just needs to get the local authorizations in the Middle East.
Yeah, it's quite a paperwork intensive process in Dubai. Local regulations, nothing particularly difficult, just time consuming. And every time we get one piece of paper signed, it seems to lead to another one. But we did actually get an email just today saying that we think we've got all the paperwork in place, so can now go through the last hoops. So that should be imminent. But we've already received the deposit, so. Yeah.
Good. And then sort of putting all that together, Ewan, you mentioned that the first half has obviously been flying, which is absolutely, you can see that through the numbers. What's your sort of like the broad outlook for the sort of second half and the full year? I mean, I've upgraded my estimates to sort of like 43 million for revenues for this year and 12 million for sort of EBITDA, and giving a sort of EPS of about 25p. So that's sort of my broad brush. But what are you seeing at the sort of like, in terms of the coal face?
Yeah, well, we're certainly confident of another move forward in the second half. We expect second half trading to be ahead of the first half. We have 2 or 3 large rental projects that have continued on from the second quarter into the third quarter. And as we've mentioned, 2 new contracts starting will now start in October, which will continue that momentum on into Q4 and well into next year as well. So we won't stop flying anytime soon.
Great, excellent. And I would just highlight to investors, I mean, in terms of the sort of the valuation, etc., and sort of like the value of the shares, I mean, they're currently trading about sort of 260, 270, and I've increased my valuation from 330 to 400 pounds. Sorry, 400p per share. So, well, we can always hope, can't we? won't be too long with a bit of luck. In terms of sort of like just on the investments going forward, and I know you mentioned in the statement sort of innovation and other sort of like strategic investments you're doing in your infrastructure and stuff, Peter.
Yeah, I mean, we're putting a quite broad-ranging investment into systems. We're replacing our financial systems, we're replacing our manufacturing systems, we're replacing our rental management systems. So there's a lot going on in that, and doing a lot of work to harmonize all the IT infrastructure across the group and make it absolutely bomb-proof and cyber secure. So there's a lot of work going on there. Won't be, huge financial investment, but it is nonetheless significant over the next 12 to 24 months. We don't need to invest any more in the factory for the foreseeable future. We will be investing in new depots, but that's primarily working capital. There's not a huge amount of equipment goes in, and fleet. So I think fleet investment is the dominant focus. Every spare pound we have that we don't want to pay out to shareholders by way of dividends, we'll be looking to target into fleet investment into the hot sectors that we have around the world and expanding our geographic footprint. So
great, yeah. So primarily organic growth then, essentially.
Yeah, absolutely.
And coming from the hire fleet, right? Sales obviously strong, but the hire fleet with a higher EBITDA drop through rates should continue seeing that operating leverage.
Yep. Yeah.
Good. And then just finally, Ewan, in terms of sort of news flow, we've probably got we need to have a trading update at the beginning of January, do we? At the end of Q4.
There'll certainly be a pre-close early February ahead of the April results announcement, but we might release something in December as well. So we'll see.
Brilliant. Okay. Well, massive congrats, guys, and. As I say, you're solving the world's energy crisis here, so single-handedly. So keep up the great work, and if you keep sort of producing those load banks, then it's sort of going to help a lot of Germany, I think, over the winter as well. So really well done, guys, and look forward in touching base going forward.
Thanks very much, Paul.
Thanks, Paul.